So the basic problem you want to solve with the current system of fractional banking and interest rates and central banking is price stability, which means that you have to have more dollars if there's more stuff to go around in the economy, and less dollars if there's less stuff to go around in the economy. And to me that's a really simple problem to solve. Because, for instance, let's say that the dollar becomes 1,000 times more valuable. So one baker sells a bread for $1, and this baker has a new machine and he can suddenly produce 1,000 loaves of bread, but there's still $1 in the economy, so that dollar becomes 1,000 times more valuable. That's a problem because there's no coin that is 1,000th of a dollar. At least if you look in the US. But there is, of course, if you go to Indonesia and you buy rupiah, if you exchange $1, I guess you get at least 1,000 rupiah for $1. And so then if you take the rupiah back to the US, you could pay with 1 rupiah for your loaf of bread and your problem is solved. Basically you have created money into the economy. And the way that would work in the United States without going to another country is by using a multiplication factor on each account of each person with a bank account. You say each Monday of the month the central bank will multiply your account, the amount in your account, by a factor that it deems necessary to maintain price stability. So, for instance, on January 1st you have $1 in your account, or half a dollar. You have 2 people in the economy, it's much more cozy. And half January, this baker gets his new machine and he can produce 10 times as much bread as before. So, in the end of January, the central bank says, okay, we have to increase the amount of money in the economy, so we're going to multiply each citizen's account amount by 50. And so that happens, so the February the 1st you suddenly have $50 in your account. Or something like that, I'm sure, I'm hoping I'm counting well. But you have just more dollars in your account. And you go to the baker and lo and behold you can still buy bread for $1. It's the same thing. It's not inflationary because you and somebody else both have experienced increase in money. It's not, there's no power structure being augmented. The government isn't the first owner of the money and then the bank the second owner of the money, thereby giving them much power. No, it's just you are the first owner of a little bit more money, which is instead of $1 you now have $50, but that $50 buys exactly the same as $1. Or I don't know, but that system is I think much more just to society than the current system, and it's very easy to implement because everybody, you can simply say, you know, you need to have a bank account, at least one, and if you want to enjoy this system, then at the first of the month you always have to have all your money in that bank account, and then it will enjoy this price stability management factor. And then after the first, of course, you can distribute it again, put it in other accounts and do whatever you like. Or every 3 months you can do that. And that would be a way to manage price stability without central banking and the whole shenanigans. And I'm trying to explain why that whole central bank system exists at all. I think one reason can be found in the fact that earlier in the history there had to be real distribution of silver and gold in banks to be real collateral for the dollar bills of the fiat, when the dollar was really good for 1 silver coin. But that whole logistic, just like with books, where you have a logistic system to distribute the books, now you have internet and you don't need this distribution system to distribute your writings if you want to. You can just put it on internet and everybody can find it. The banking system has developed in the same way. You have accounts, and if you want to increase the money in the economy, I think it's much more fair just to give everybody a little bit more, just by a factor, with the same effect. Anyway, I hope you find this interesting.